Retirement for Life. Your passport to a comfortable and confident retirement. The podcast that's equal parts education and entertainment, where we break down the retirement maze with a dash of fun and a heap of wisdom from your host, Christian Sear CPA, the passionate retirement specialist and president of Sear Financial Wealth Advisors, the independent registered investment advisor specializing in the Aim Retirement System.
All right, guys, welcome to the Retirement for Life podcast. Today is the market is crashing. What should I do? This is a definitive podcast. I want new clients who come in for the first time to watch this because it helps explain what we're doing to protect people. But more importantly, Andrea and Emma, when the market goes down like it has recently, do you get phone calls?
I get quite a few phone calls. Actually, clients say that I talk them off the ledge.
Right. Yeah. I feel like this should be the video that people watch, the podcast that people listen to anytime we receive a phone call like this, because it is a bit repetitive. I look back, 2013 are the first documents I have where we're trying to help clients understand what to do in a down market. So today we're going to answer that question. I think it's really great because Emma's going to show us how we're basically setting up a retiree's situation so that in an ideal world, they should not have to really worry about the stock market. Now, can we start with a few basics here? The stock market goes up about 10x over a 20-year period. What's that mean? What's 10x?
It means if you put in, $1, it's going to turn into 10 by the end of those years. And when we're talking about your portfolio as a whole, those are big numbers. But I do want to say, when we talk to clients, they're not focused on the long term. They're literally looking at the stock market over the last week and seeing that drop.
Yeah.
And I think, rightfully so. A lot of our clients, they've saved their entire life for this moment.
Yeah.
So they don't want to see everything they've saved lose money, which is why I think maybe this podcast can help give our clients an idea of, yes, you see the stock market dropping in front of your eyes, but in reality, if we stick it out for the long term and put these guardrails in place, they're going to be better off.
Yeah. And when I have these conversations, I always go back to the plan that we've constructed for them and explain to them why they don't need to be worried.
Mm-hmm.
Yeah. I mean, so what I wanted to say first and foremost is that the stock market is not the bad guy. It gives us scares, but it can really lead to, over the long run, making us money. And when you get out of the market, you often make mistakes. And that's what we're going to talk about. And Andrea, I know you want to play the guess the number game. So let's just give a person an example of what happens when they get out of the market and they miss some of the time.
Yeah. So my article is 3 reasons to stay invested right now from Fidelity. Basically, it's, when the market is volatile, clients want to seek safety. But my article was about why that can backfire. So a hypothetical investor who missed the 5 best days in the market since 1988 through December 31st of 2024 could have reduced their long-term gains by what percentage?
It's a long time period.
Yeah.
I'll get my marker out. Okay.
I feel like we've got to redeem ourselves here, Andrea. And
good luck, Emma.
All right, I'm ready.
Okay, so if you just missed 5 days in the last...
5 of the best days, which counterintuitively is during a bear market a lot of the time.
Okay, so and the reason you asked this question is because I get out of the market and then I'm not in it. And the reason was so I don't lose money, but actually by getting out of the market, you're losing money because you're missing some of the best days which occur.
Yep. Which usually occur while the market is down.
I've got my answer.
The bounce back days. Yeah, me too. Okay, here we go. Oh, we're
Emma.
way different. 26. Okay, 37%.
Yep.
I mean, the 5 best days, you think about those days where, after the market's dropped significantly, the next day can be a huge bounce back. So even with just 5 days, it could be We're talking at least,
This is not a
50%
fair
every day.
question. Because like
You're
what's
just
the
mad
annual
that you lost.
what's the annual return over that
Well,
period?
we're talking
10%?
just 5 days,
We're
so
talking
they're
just
missing
the
out
difference in
on,
those 5 days, what they've missed out on.
All right, so help
like
me
if the
understand.
market bounces back 5% one
So
day, they miss
if
that.
you've missed those 5 best days, if you had started with, the $10,000 in 1988, you've missed those 5 best days, you would have about 330,000. If you kept in the market and hit those 5 best days, you'd have over $500,000.
Okay, so this is a total return over the entire period.
The long-term gains, yep. What they missed. Are you just mad that you lost?
I think that's the point for me. So I'll take it where I can get it.
Fight. Okay, that's fine. I'll accept the loss. So here's the thing we're doing with retirees' portfolios. Okay, Emma, do you want to explain?
Yeah. So like I mentioned earlier, if you have the right advisor, they should be setting you up for success. And one of those things is your allocation during that danger zone. We've talked about the danger zone many times where, the 5 years before and after retirement, you should be allocated maybe the most conservatively that you will ever be allocated in your life. So what that looks like is what we've talked about before, those guardrails, including mailbox money, which is huge. We typically allocate anywhere from 15 to 25% of a retiree's portfolio to mailbox money.
Mm-hmm.
And, Andrew, we talk about this every day.
Yep.
It's a portion of your portfolio that is not going to lose money, but also provide you that income in those years from about 70 throughout the rest of your life, and make sure that you're set up for success. The other thing is the bond portion. We have bonds in our retirees' portfolio to last them until they start Social Security. That's where their income is going to be coming from.
Yep.
And then we have essentially the cherry on top, which is those stocks. And we're typically allocating anywhere from, 30 to 60% stocks, depending on someone's risk tolerance. But though that's an area where we have those guardrails in place and we don't have to even worry about that stock portion.
Exactly.
It's more just there for growth.
Okay. So what we're saying is, according to a recent study, the average American feels like they need nearly $1.5 million to retire comfortably. That's a 53% increase compared to the same study just 4 years ago. But is that the right number for you? And are you doing everything you can to maximize your financial situation? The Aim Retirement Assessment can help you figure that out. This free assessment is a simple 3-step process. Answer a few questions about yourself. Spend 15 minutes discussing your situation with one of our retirement specialists, and then we get to work. You'll receive a customized report detailing your exposure to the 7 biggest risks in retirement and the 3 most impactful action items you can take to supercharge your retirement. And if you already have a financial plan, this assessment will help you see what real retirement planning looks like. Get your AIM assessment today and see the difference between a financial generalist and a retirement specialist. Go to aimassessment.com today to get started. That's aimassessment.com. The stock market can be awesome, but it can also be awful to retirement. And yes, we've talked about this so often on this channel, on this podcast, that the danger zone is crucial 5 years before and after retirement. And when we're putting together a 35-year plan in place, we're aware of that, which is why we're using a conservative portfolio allocation. If you look, for example, right here, typically only half of your money is in the stock market for our typical client.
Right.
And the other half is being used to essentially, as much as possible, guarantee income starting at age 70 usually and going for the rest of your life. And everyone's situation is different, but this is a great visual. I know there's a lot of stuff going on. It looks like Las Vegas. But what we're showing here on the screen is that your income need is basically filled up by things besides the stock market.
Right.
And I think that's an important point. And by the way, when the stock market goes down, what are we doing? Are we selling all of your stocks?
No.
No, we're watching it, and actually when, the stock market goes down, that's actually a great opportunity for us to re-up your equity exposure and buy when the prices are down.
Yep.
So really, if you need money out during that time, we're giving you that income from your bonds rather than the stocks, and actually buying stocks when the market's down.
Dollar
Yeah.
cost averaging.
Yeah. I've done a lot of work on it recently. And even when the market goes down by 25%, there's very little, if any, distributions retirees are taking from the stock market. So the point is that you will recover. The stock market will continue to go down. If it's a small drop, like a correction, what do they call it? Like 10 to 20%, like we just saw.
Yeah, which is the majority of the drops that you see in the stock market are just that smaller correction.
Yeah.
And so the history shows us that if you have a correction of 10 to 20%, the stock market will take about 5 months to go down. And it'll take about 4 months to come right back to where it was.
Yeah.
And so the video I made recently of one particular client was that he got out at the worst possible time. And now he's trying to wonder when he should get back in, because the day he got out is when the stock market marched up 75%.
Right.
And so just be patient, because what we're doing is we're saying, look, the stock market is going down, but we don't know when it's going to start to go back up. And by the way, when it does go up, it's going to go up a lot, and we don't want you to miss that. So,
which is the point of my guess the numbers was you don't know what day to get back in. You could miss it.
All right. So
yeah, that's actually a great intro to my guess the number game too, which we should do now. So, we've seen the last 5 or so years have been fairly good. We've seen ups and downs, but what I really want to talk about is, some more turbulent times. So we're talking, the dot-com bubble, the 2008 financial crisis, and then most recently the global pandemic, the 2020 drop in the market. So that's, the time from 2020 or 2000 to 2020. If you had stayed invested in the S&P from that time period, 2000 to 2020, what would your average annual total return have been? So this is staying invested throughout all 3 of those extreme drops, and also staying invested, when it bounces back up. So it's the total annual return.
So this includes the tech bubble where it went, that you said, where it went down 50%, and 2008 where it went down, what did Andrew say earlier, like 55 to 58%.
Yeah.
Okay. All right. Yep. By the way, this is a fair question. I'm not happy with the last question. Brooke, we're going to have to go to the
I'm
judges.
happy because Emma got it right.
Okay. Total return, and got it. All right.
Dividends.
All right. Let's see what your answers are. 8.9. Andrea, 12. The correct answer is 6.62%. So that just goes to show, there's positive return even when you see extreme downturns. This period includes, over a 50% drop and 2 30% drops. And yet the 21-year period that we're looking at here, you still would have had an average annual return over 6.5%.
Okay. So what have we said so far? Stocks go up over the long term. Protect your portfolio with the right advisor. This is my proof. My favorite class in high school was geometry, and it fit my mind because you state facts, and then after you state facts, you can jump to a logical conclusion. So if I could say one thing and one thing only to a person, an investor, a retiree, who was thinking about getting out of the stock market because it was going down, I would say this: with a proper retirement portfolio, when the stock market goes down, there are 4 things happening. Number 1, your mailbox money and your Social Security generally are what determine your long-term income needs, not the stock market. Okay? This is the properly set up retirement. I'll say it again. Number 1, your long-term income is dependent on Mailbox money, and Social Security. Number 2, if you do need distributions above and beyond your mailbox money and your Social Security, it's not coming from the stock market either. We are taking that from bonds. Generally, number 3, when the stock market goes down, bonds go up. So you're not selling your stocks. We're waiting for them to recover. Point number 4, the stock market always recovers. That's what I would say if I had. That's not one sentence, that's several sentences, but that's what I would say. And
yeah, you've done all the work to choose your advisor, and hopefully you've chosen one that is putting you in a position where you can succeed. And so that should remove all of the stress for you and allow you to kind of ignore what's going on in the market and just trust in your advisor that they're doing what's right for you.
Okay. There are 6 basic rules of investing. Okay. Choose the best investments, reduce fees as much as possible, minimize taxes. And what's rule number 4, you guys?
Remove emotions.
Remove emotions. Okay. 5 is don't listen to gurus, and 6 is be diversified, which we've talked about, a diversified portfolio. You have to keep your emotions out of investing. Every study, and I'm not going to show it on the screen here if you're watching this podcast, but every study over the last 50 years by people smarter than I show that people who get emotional in investing, they're just doing themselves a disservice, okay? Yep. It depends. They'll say like you'll lose 1% to 2% a year over the average, but as that video that I had, as I showed, we have a client who's at $250,000 because he got emotional, okay?
Mm-hmm. You're essentially trying to time the market, and if it relies on your emotions, most likely, that's not going to be a positive thing. You're most likely going to miss out on those bounce back periods.
Yeah, I mean, just in general, making a decision based on any emotion is not a good idea, but especially in this case.
All right, so one more guess the number game. I want you to show this chart, Brooke. I found this fascinating. It relates to what Andrew was saying. So $10,000 invested over a time period. This was what, 15 years, 20 years? This was something similar that you just said, Andrea. Look at this. You make some money here, $70,000, I guess. Just missing 10 days. It's incredible. So here's a question for you. All right, so here's my guess the number game. Studies show that if you miss just a few of the best days in the market, like Andrea told us, you're going to miss out. I have a bit of a twist on that. Over the past 20 years, the S&P annualized return has been 10.4%. So if you invested $100,000 20 years ago in the market today, you'd have $723,000. Well, what if you missed the 10 best trading days? So my question to you, Andrea and Emma, is what would you have? You would have something less than $723,000 in your account by missing the top 10 days.
Okay.
I can't wait to see your answers.
I'm nervous. 400,000.
I said the exact same thing.
Oh my God.
Okay, I call the under. I'm taking the under.
Brooke, what was the answer?
The actual answer is $326,819.29.
Yeah.
All right, we'll take a half point.
I'm still protesting the first question, but whatever. Whatever.
Sore loser.
Here's the deal. It's always your decision, but you've hired a financial advisor, hopefully a retirement specialist, and you're nervous. And you need to trust the person that you decided to trust or the group of people that you decided to trust.
Yep.
And if you're in the right position and your retirement's been structured properly, you should not have to worry much or at all about the stock market.
Yeah, I find it to be an easy conversation when you look at their structure of their plan, and you can just show that to them and they prove it to them that way, and then they are more relaxed.
Yeah, we've included the mailbox money that will not drop. We've included bonds. That's where your income's coming from. there's no reason to worry because likely the stock portion of your portfolio is going to bounce back as we have just showed, and it's much more harmful to get out of the market than just ride it out.
Yeah. And if you do insist on getting out, I insist that you tell me when you want to get back in.
Yeah.
You know, I always love the customer. He says, okay, I'm getting out. I don't care what you say. And then he says to me, and you'll tell me when to get back in, right? No, I will not. That's the whole point of this podcast. You don't know when it's going to recover. All you know is that it will recover. So,
Yep.
All right, guys, thanks for a great show today. Brooke, thanks a lot. Emma, Andrea, I know we have work to do, but it was a great show. Let's make every person who calls the office from now on listen to this podcast so that they have a better understanding of why they should just stay invested for the long term. Until next week.
Thanks.
Perfect.
Thanks, guys.
Bye.
Investment advisory services provided by Sear Financial Inc., SEC registered investment advisor. All content on this podcast is for information purposes only and should not be considered investment, legal, or tax advice. Material presented is believed to be from reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness.